Hello, my name is Yen Liow. I'm the founder and portfolio manager of Aravat Global. I'd like to thank Professor Richardson for this opportunity to present to you in the alternative investments class today. A couple of presentations that I hope will help your careers. This one will be about a 15-minute video on the topic of the evolution of a public market investor that over the next 15 minutes, I'll try to highlight some key areas that I hope will advance your careers. Before watching the rest of this video, if you could please review this disclaimer. Thank you. So what are the most important 10 years of your life? Are they your 20s, your 30s, or your 40s? As my son loves to say, what's the most important meal of the day, Dad? It's breakfast, until it's time for lunch. So the answer for you is the next 10 years, always. And this 10 in particular is going to be incredibly fun. Make them fun. Before we get into the rest of the slides, I'd love to share with you another video that was done with Columbia Business School over the summer, actually during earlier of COVID. It's referring to, on YouTube, Mastery Learning How to Learn. In there are a series of learning skills that I've developed over the past decade or so that has helped my investing career, and I would hope may assist yours. So earlier in my career, this is before I went to business school, when I was working for Bain & Company, Dell was one of my clients. And so in this period, I was out in Asia, actually trying to help them build out their Southeast Asian and China practices. And Dell's stock almost 4x'd over an 18-month period. It absolutely lit up my imagination. First of all, how could a company grow this fast? And then second of all, how could this kind of wealth be created in such a short span of time? And that really lit me up as both an investor and a business person. However, the other side of it was also very important. Once Dell came out of the dot-com bubble, it really struggled for a considerable period of time before actually going private. And it was another area that I really wanted to understand is how did hypergrowth transcend into a much more challenged environment? It really opened my eyes to business analytics as well as a whole life as an investor. So this is the main content for today. I want to talk about the analyst journey. So for most of you, you'll start as an analyst. And there are two very major transitions to becoming a portfolio manager. The first is from an analyst to a moneymaker, and then the second from a moneymaker to a portfolio manager. There are four key areas I wanted to highlight that I think are very important step-ups for an analyst to a moneymaker. They are idea generation, understanding the nuances of risk, having the courage to bet in sufficient size to make real money. And then finally, how do you handle losses? One of the major differences between a professional and an amateur investor. The step up between moneymaker and portfolio manager is largely around systems level risk management, an area I'll touch on but won't spend as much time on in today's discussion. I won't be touching on idea generation. There are many other speakers and tons of content out on there. I'm going to focus on the other 3 points. So the first of all is understanding what is risk. Risk and uncertainty are vastly different things. Risk is always a function of price. Uncertainty is an inherent part of what we do in investing. We are dealing with the future, and the future, by definition, is unknowable at the time that you have to place a bet. The two often overlap, but they are completely different concepts. A book that I would highly recommend on this concept by Manish Pabrai is called The Dundo Investor. I think Manish did a wonderful job encapsulating this concept. And then one of the masters who has exploited the difference here is Richard Branson, who has over 300 entities now under the Virgin brand. In terms of handling loss management and understanding risk, another very important concept is understanding the difference between marking risk and permanent capital loss. And henceforth, do you add down or hold through or cut at that moment? So the x-axis here is time, the y-axis is price. And volatility when it hits in that moment is what we train for. I call this the bottom of the Nike swoosh. In certain situations, you need to differentiate between, is this a moment to be aggressive and it's opportunity, or is this a moment where the stock will never come back and that's truly permanent capital loss? An example of this would be an FDA finding where you don't get a drug approved and it's a binary outcome and it's negative. The stock is not going to recover from that. Courage is another important chapter of my evolution as an investor. And I think it's a very, very important step up between having insights and being able to monetize them. These are three of the guides that helped me on my journey to have the courage to make my insights count. So leaping from the comforts of just doing analysis into the unknowns of actually being able to monetize and monetize in real size. Markets are efficient most of the time, not all. And investing requires you to have the courage to bet and bet in significant size when those inefficient opportunities occur. You don't get to play the same game twice. Markets are sufficiently efficient that they don't let you do that easily. So the first gentleman is John Wooden. I would recommend strongly reading everything you can. John Wooden on leadership is a wonderful book. What he liberated for me is process versus outcome. And so part of what he released in my soul was understanding if you play your best, you may still not win, but you cannot lose. I think there's something very empowering about you giving something your all and just letting the vicissitudes of outcomes decide for itself. But if you keep doing that repetitively, you will eventually win, or at least you will find your place. The second is by Bob Rotella. Dr. Rotella was Tiger Woods's, or one of Tiger Woods's original sports psychologists. He's a leading sports psychologist on the PGA. He's written several books, including this one, Life is Not a Game of Perfect. Golf is Not a Game of Perfect was his original book. And it was a wonderful gentleman I spent a little bit of time with in 2006, 2007. And what he shared with me is there's no such thing as overconfidence. This blew my mind a little bit. What did you mean, Bob? And he said, if you are fully prepared, you are ready to meet the moment. Again, you may not win, but you are fully ready to discover who you are. Release your soul, swing six, and just go for it. Trust your preparation. Again, very liberating for me. And then finally, His Holiness the Dalai Lama. I've done a tremendous amount of reading on Buddhism and spent a little bit of time with His Holiness and his senior monks, and it was a great honor. And the main point he shared with me is for courage, if it's based on real and not false confidence, then trust your instincts. If it is not arrogance, but based on real effort, work, insight, again, go for it. That is based on very strong foundational elements. Go find out who you are, go place the bet, and trust your instincts. These were very, very important moments for me that allowed me to monetize. The next part of your journey is how you deal with mistakes. Mistakes will be a common partner in your journey. The first here from Charlie Munger is, forgetting your mistakes is a terrible error if you're actually trying to improve your cognition. The second quote here is from Josh Waitzkin. In the long run, painful losses may be proved to be more valuable than your wins. I wholeheartedly agree. I think you learn a tremendous amount from failure. You learn very little from success. And so the drawing over here, is the picture over here, is the Gandalf moment, where I term this emotional versus intellectual learning. You need to feel your mistakes deeply, but only deep enough that it helps and not hinders your development. If it's at the pure intellectual layer, it won't do anything to you. But if it's done deeply enough at the emotional layer, you won't repeat them and you will learn them. So Gandalf did this moment where he's fighting off a demon and he holds his staff and he shatters the bridge and he goes, "Thou shalt not pass. That will never happen to me again." That is the level where if you get big mistakes, you can generate incredible insights and it will release a tremendous power within you to monetize going forward. Pain tolerance. I want to remove a misconception about pain tolerance. People talk about, wow, they can take a lot of pain. Actually, investing pain tolerance does not equal willpower. In fact, willpower exhausts at the worst possible time. It has nothing to do with willpower. Pain tolerance, I would argue that all of us have the same pain tolerance as Warren Buffett. It just depends on the framing. And so what it means by this is understanding your source of strength. If you understand your why, you will find your how. So let me give you a thought experiment. There aren't too many of us who would run into a burning building for a few $100s. Some of you may run into a burning building for $1 million. If you have children and your children are in that building and it requires you to put yourself at risk in order to save their souls, most of us would run without hesitation into that building. When you understand your why, you will find your how. It's understand the contextualization and your source of strength. The difference between struggle and suffering is meaning. If you have profound meaning in it, it's just a struggle. You will power through. If it has no meaning, you will suffer, and often you will break. So finding your box, this is a term again from the Navy SEALs. Your box is the place where you can be quiet under unrelenting attack, where you can find equanimity. You need to be that place and discover that place. This is the inner game of investing. And when you understand what lets you be patient, when you understand what lets you, where you find conviction from, that becomes your box. And the world will test you with violent volatility at times. And once you've found that point of equanimity, you can ride these giant waves as seen in this picture. Shifting over to the step up now between moneymaker and portfolio manager, it's really around systems level risk. I'll give you a couple of key tips here. The first on risk management, the first rule of risk management is just awareness. Are you even aware of the risks you are taking? And are you taking them intentionally? The second one is if you're gonna panic very quickly or not at all. Markets are an extremely expensive place to discover who you are. And this is one of the rules where if you're gonna act very quickly, not late. So a few journeymen that are gonna be permanent members of your tribe through this journey of investing. The first is fear. Investing requires a bit of a rewiring to your neurological system. Part of the reason here is if you choose your game wisely, fear is actually the bearer of gifts. If you're hunting high quality businesses, which is what we do, exceptional businesses rarely go on sale. They're really cheap, but they only do so when fear turns up to the party. So you have to learn to embrace it. Fear will override the neurological systems of most investors and they will dump illogically. That is the exact moment that we must step into the fight and have the opportunity to buy high quality businesses. Greed and envy, this is the bearer of danger. Envy is the only one of the 7 deadly sins that actually is all downside. That is also true in envy's role within investing. Greed and envy are incredibly dangerous for capital preservation. The other side of these bubbles results in tremendous value destruction. Uncertainty is another member of your tribe. Investing is dealing with the future. The future, by definition, is unknown and many parts will be unknowable. You need a system to deal with that uncertainty and then learn how to embrace it. So this is Cyclops. And the legend of Cyclops is they gave one of their eyes in order to see the future. But what they learned was it was only the day of their death. The other fun fact in here is, I didn't just know this until preparing for this lecture, but Cyclops were also the blacksmiths that made Zeus's thunderbolt. Anyway, the uncertainty element of investing is a very, very important concept and you need to learn to embrace it. And if you're one of these people that needs always the incremental data point in order to make a decision, this is the wrong game. The future is something that will ultimately be unknown and unknowable. You need to learn how to probabilistically deal with it and move on. Volatility, the final permanent member of the tribe in your quest to evolve as a public market investor. Let me separate here systems level versus idiosyncratic volatility. Systems level volatility is market-wide volatility. Huge levels of funds flows that are driving the market, whipping it around, a natural part of market structure. Idiosyncratic volatility is single stock volatility. In general, idiosyncratic is larger than systems level volatility, and it also can be idiosyncratic in that it has no bearing on what's going on in markets. The other factor here that I would like to strongly highlight, and this comes down to game selection, is monopolistic versus cyclical volatility. We hunt monopolies and oligopolies at Arabat Global. Our stocks are volatile at times, but our businesses in general are not. And so monopolistic volatility, in our view, presents more opportunity than risk. Cyclical volatility, I have no idea. It's closer to three-dimensional chess. So the two charts in the below here, the left side is monopolistic, the right is cyclical. The x-axis is time, the y-axis is price and intrinsic value. The intrinsic value curve for monopolies is steadier and up to the right, not straight. And the squiggly line is price volatility. So monopolistic volatility, the businesses are fairly stable in their compounding of intrinsic value. And when prices become volatile, you have an opportunity to attack. If not, just hold through. We are in the business of arbitrage between price and intrinsic value. If intrinsic value is as volatile as price is, it's a very difficult thing to engage. And so on the right side, that is what I would regard as more cyclical volatility. And when the two are dancing at the same time, it's very difficult to arbitrage. This all comes down to game selection. And that's the reason why, among many, we hunt monopolies and oligopolies. So what do? Our long side of our long short fund hunts horses. Horses, we define them as monopolies and oligopolies that compound earnings per share 2 to 3 times broad market averages for long periods of time and trade at what we believe are reasonable prices. We believe this has driven the vast majority of outperformance in markets over 5 and 10-year rolling periods in the past 60 years of markets. Our true north is we believe that our portfolio returns will converge with realized earnings power of our portfolio over time. So the x-axis here is time, the y-axis is price and intrinsic value. The intrinsic value curve again up and to the right, which we believe is a function of earnings per share or free cash flow per share plus dividends, and then price again being the volatile factor here. Our job is to find companies that can generate brisk, durable, persistent cash flows and wait for price to come to us, and then let them compound for long periods of time. A word of caution about your careers. Done right, actually investing is an art that can be refined and it can improve well into your 60s, 70s, and even later. However, there are elements of it that are very much like professional sports. There is a danger zone that you must be aware of in your career that is your mid to late 30s. And it's even a lot harder when you get into your 40s. At that point, you either have to stick with the fund that you're with and stay with it for a very long time, become a portfolio manager or be prepared for a career transition. None of these are bad. I just want you to be fully aware. It's very difficult to switch teams when you are an analyst in the professional investing world. When you're in your late 30s or even into your mid 40s, it does happen for sure. It's just the TAM is considerably smaller. Finally, read a lot. This is a game of competitive learning. Here are 3 books that have changed my game and I wanted to share with you. The first is The Art of Learning by Josh Waitzkin. I think Josh has done a masterful job here in dissecting some of the skills and processes required to take any art to the high levels. Genghis Khan and the Making of the Modern World by Jack Weatherford. I think this is one of the 5 most important investing books of all time. This profoundly changed the game for us. This is what my firm is named after, as well as the whole notion of unfair fights and high quality businesses. And then finally, Gautam Baid's recent book called The Joys of Compounding. I think this is a wonderful book that talks about, again, the life of competitive learning and all of the elements on compounding advantages that over time leads to what I believe is a very enriching life, fulfilling life, and superior investing strategies. With that, I thank you for your time, and I look forward to seeing you in person soon.